Okay, so I think that we'll get started. So thanks all for joining us. It's so nice to see you again this week. Greg and I have struggled harder than ever this week to figure out what the best things to talk about are, because the reality is there hasn't been a tremendous amount of major informative news this week compared to the last several, which is a welcome relief. So one of the things that I thought I'd start off with is just a thought that I've been having, and I've spoken to some of you about this, just one off, but it's really stuck in my head, and it goes back to this versus 2008, 2009. And what I've realized is so different what I've realized is so different this time is that normal human behavior has been quashed, or at least put on hold right now. In 2008, 2009, if you were financially stable, if your income remained the same, which it did for many, I would argue most people, you were largely unaffected and life was normal, and you're out driving and going to the movies and driving up and down the highway and looking at billboards and eating out. And this time, everyone's been forced to hit pause. Everyone. Doesn't matter if you were rich starting out on this or poor starting out on this. Everybody's hit pause. So I think what's interesting is there's silver linings to every situation. And one of the things that we've seen by everyone being forced to hit pause and everyone being forced to decrease their consumption is the fact that, sorry, I've really messed up my view on this. So if I'm a little off, I apologize on that. But is that everybody's been forced to decrease their consumption. And as a result, what we've seen is the personal savings rate has increased dramatically. It's gone up from about 7 or 8% to about 13% over the last month, as many people whose income has remained stable and who haven't been able to spend the way they normally have just started to hoard cash. And so one of the things that we're starting to think about and talk about is how there's counteracting forces for everything. So as we've seen the government debt balloon, and I know that these are not equal, it's just an interesting thought that we've been working on. But as we've seen the government debt balloon, what we've also seen is that individuals in many cases have increased financial security right now compared to what they did before. So as we come out of this, and as the economy does open back up, we're going to see many people whose personal savings rates are much higher than they were before, plus low interest rates, plus low gasoline prices, plus just straight up pent up demand and excitement to do stuff, to go to Disney World. Jonna in the other office is desperate to go to TJ Maxx. She can't wait to get there. She thinks it'll be good for her soul when she gets there. So those are the kinds of things that we're looking at. And it'll be interesting to see how it plays out. One of the other things we struggle with is that this is a tricky situation and there is no economic model for this. We've never seen anything like this before. Just a quick aside, since I mentioned TJ Maxx, just before we started this call, I saw an email pop up with the headline quoting Mark Twain saying, the retailers are saying rumors of our death have been grossly exaggerated. And I think that'll be interesting to see. We all have kind of thought of retailers as just, DOA when we come out of this, and I don't think that will be the case. And it'll be interesting to see who survives and thrives as we come out. So one other thing, what I think is interesting as we sit here today too, is that the market over the past just about month, between April 14th, so middle of April, and today, the market is flat. Our portfolios are pretty much flat over that time period too. And I think that's kind of surprising because we've had so many big up days and so many big down days over the course of the past month or so that it feels like more movements happened. I personally take a bit of reassurance in that flatness and that we're still down. I realize with each of these calls we say, oh, that the market's down about 11%, Russell's down this, equal weighted's down that. But the reality is we've stayed pretty flat. And I think what happened was we went from the huge decline in March to massive Federal Reserve injections of liquidity, and that ratcheted the market up a bit. And now what's happening since the middle of April is that we're trading and we're moving off of real news as often as we get it. So news on policy, news on virus, and then economic data as it's come out, and corporate earnings data as it comes out. And so for me, I'm happy to see that and reassured, because that's a healthier base to build on and to grow off of as we work our way out of this. I'd rather see that than see just the lights off, just straight up to the upside. So I think what we're working on right now is creating a better foundation off of which we can grow. I'm going to turn it over to Greg so that he can tell us a little bit about the news that has happened in the past week. All right, Greg, let's see. I'm going to try and spotlight your video. Okay, go for it.
All right. The good news is that there wasn't a lot of news this week, so this will be briefer than normal. No new policy changes. The Fed continues to buy assets at their measured pace with unlimited power, but nothing new from the federal government in terms of policy. No meaningful new economic data that's been out. What we're seeing is that we're getting a lot of the economic data now is becoming stale because the data that's going to be coming out is going to tell us about April, when in reality what we care about now is more about what's going on in May, because a lot has changed in May. States are starting to reopen, so the April data, while it'll tell us how things were at its worst, it doesn't accurately reflect what's going on in the economy today, since things are changing so rapidly. There's not a lot of importance to the economic data as far as moving the market. It's going to be terrible, but we think it's going to be manageable for the next few weeks. As far as cases, the number of cases has plateaued or is slightly declining in the U.S. There's two things going on. One is a sharp decline in the number of cases in New York, where New York, the number of cases and hospitalizations are down about 80% from the peak. Outside of New York, there's been the number of new cases of COVID are about flat. But I think it's really important to look at the data carefully. I see a lot of headlines that anytime the number of cases go up in any state or city, the newspapers rush out with the stories that, oh my God, the number of cases are rising, we're back to where we were, and things are terrible.
Right. Can I say something on that
Yeah.
real quick? This reminds me of my favorite Bill Gates quote, which is actually him lifting it from this guy, Steven Pinker, who's a professor at Harvard. But what Bill Gates says is, headlines in a way are what mislead you, because bad news is a headline and gradual improvement is not. So,
Perfect.
Sorry, take it away.
So what's behind the plateauing of cases, especially outside New York, is just an increase in testing. So we've moved from 2 months ago, we were testing 200,000 people a week. Now we're up to about 1.7 million. That's up about 10% over the previous week. So while in the last week, the number of cases, total cases in the US went down by, it was I think high single digits, the number of tests were up by 10%. So the percent positive of the tests is actually going down quite significantly, but that a subtle improvement in the positivity rate doesn't make for a great headline. It's better to say, oh look, Georgia cases are up, the virus is rebounding, we're all in trouble. That's a sexier headline. The headline, if you look at New York's example, that the positivity rate fell by 1% is not a very exciting headline on a day-to-day basis. But when the positivity rate falls 1 to 2% every day for the past 5-6 weeks, the positivity rate goes from 50% down to now it's about 10%. So a huge improvement, but it doesn't grab the headlines as some of these sensationalist reports out there. So just be careful looking at the data, because especially now the bias in the media, I think, is going to be they're looking for evidence that the measures to reopen states are not working, and it's causing an uptick in the virus, and that's going to make for some very interesting stories. And that may be the case, but more likely is that the results, a higher number of cases, is probably going to be the result of more testing. And we want states to do more testing. But I think the scary thing for me is that we're disincentivizing states to test more, because if you test more people, you're going to find more people who have the virus. But that's what we want. We want to test more. That's the way to beat the virus, is to have ample testing, so everyone who wants a test can get a test, and people who have the virus will quarantine themselves, and that will slow the spread. I think we're in a trap where your states are going to be reluctant to test more because you're going to find more virus out there. So that's my commentary on testing and the number of cases. On a more positive news, we got news this week that Pfizer has started human trials on their vaccine. This is part of their partnership with a German company. We now have 5 vaccines that are in human trials. this really is remarkable considering how fast this has happened. If you look at the speed, even back to the speed of the development of the Zika virus, a Zika vaccine a few years ago, that took 190 days to go from the lab to human trials. The vaccine that we've developed so far, Moderna, did it in 120 days. So 120 days versus 190 days. We just continue to accelerate the timeline to develop a vaccine. Some interesting points about the vaccines. So there's 5 in human trials right now. I think one of the most interesting points is that the companies that are developing the vaccines are starting mass manufacturing of the vaccines even before these vaccines reach phase 2 trials, which is a big change in the normal development of a vaccine. Normally you would do phase 1 trials, evaluate the data, do phase 2 trials, maybe start to ramp up production a little bit to have a larger pool for the phase 3 trial, do that for a couple of years, then evaluate the data, and then finally launch the vaccine. So in this vaccine, they're accelerating the timetable by pulling manufacturing forward to having mass manufacturing. So if the vaccine is proven effective and safe, it can be rolled out in a large group of people. And we have the potential to have vaccines in phase 3 trials in probably in the fall, winter of this year, with hundreds of thousands of people. And that's just another tool that we'll have to fight the virus. And even though a full approval of a vaccine may not happen for, the timeline has been said to be 12 to 18 months, we could have phase 3 trials with a lot of people in those trials, and that will help reduce the spread of the virus in the fall. So that is a positive piece of news from Pfizer. And then we've been very busy with earnings season, and a lot of companies have reported. So far, the S&P 500, a little more than half the companies have reported earnings. Of those companies that have reported, the average earnings growth is down 13% for the first quarter. The numbers are kind of as you would expect them. The sectors that are doing the best, it's telecom, technology, consumer staples, healthcare, utilities. So the sectors that are I think best positioned in this economic environment are of course doing the best, and they're actually seeing growth during the first quarter. Meanwhile,
well, not all of them. A few of them are seeing
companies
growth.
in aggregate.
Some individual companies.
Yes, but it's financials, the consumer cyclicals, industrials, energy, materials. They're the ones who have suffered more declines. But when you put it all together, you get earnings down about 13% in the first quarter. If you take out financials, which were hit harder due to provisions, they're down. Earnings are down about 4%, excluding them. But importantly, I think one interesting number from earnings season so far is that so far only 7% of companies in the S&P 500 that have reported have cut their dividend. And of those companies, those dividends account for about 4% of the total dividends paid in 2019. So there were some scary articles a few weeks back, especially from Goldman Sachs, that forecasted that dividends for the S&P 500 could be down at least 23% this year. So far in this earnings season, we haven't seen the cuts that would be necessary to bring the dividend income down that much. So it's only 7% of companies cutting their dividends so far. So that is a little bit encouraging that companies are able to maintain their dividend.
Yeah. So going from there, oh, here, I'll spotlight me. So going from there into the portfolio itself, we've actually had I'll start with the equity income portfolio, and then Greg, I'll touch on the growth and the international portfolios. But for our portfolio, for the equity income, we've actually had about 3/4 of the companies report so far. It's been a really, really busy and really interesting last 2 weeks. And what's been, I think, the most interesting is that there haven't been any shockingly negative earnings surprises where a company just wildly missed earnings. I think a lot of that is because expectations have been lowered so much that it's been pretty easy to beat, right? What was a lowered expectation. But most of our companies have actually beat what analysts' expectations were. Again, no great feat since people were scared and lowered those a lot. There have been some extremely good reports in the mix, and these include the obvious, right? Some of the obvious. AbbVie and Pfizer, obviously excellent. B&G Foods just reported last night. They had an excellent quarter, again, as expected, as people have hoarded food and stocked up on canned goods and staples. Hercules, which is a company that we don't talk about very often because it's kind of under the radar, but it's been in the portfolio forever and ever. It's a company out on the West Coast, and they lend to biotech and technology companies. They actually had a really good quarter. It has about a 13% yield. The stock was up a lot yesterday, and we were happy to see that. Dividends really safe. We've been speaking to them throughout, so then it was just particularly reassuring to hear that all of our conversations that we've had were reflected in the earnings call yesterday. The pipeline companies have held up extremely well, and that's been interesting to watch. They really learned their lesson in 2015-16, and were very quick to make adjustments in this cycle when energy prices came down. And so they've been faring really well. In fact, Williams actually increased their distribution yesterday. So that's the one where some of you own Williams, some of you own Magellan, right? It depends on if you want K1s or not. Magellan also had a great quarter. But these companies have held up extremely well. At least from an earnings perspective. They're considered energy, and energy's been thrown out. So even though a lot of them have most of their revenues coming from the natural gas business, which has held up shockingly well, both in terms of the price of natural gas and the demand for it, the share prices have been beaten up. But their earnings have been coming in well, and their vision is really interesting. Just one side note, I think this is interesting. On the Magellan earnings call, what Magellan does is they transport refined products throughout the Midwest, so a lot of gasoline. And what they saw was in the end of March, beginning of April, gasoline demand was down about 33%. By the end of April, it was only down about 24% year over year, which means the demand for gasoline, they saw a pretty big increase in improvement as April wore on. It'll be interesting to hear what they say, about May and what kind of improvement they are, because to me, that's kind of ground zero for the pulse on the economy and for what bouncing back starts to look like. There have been cuts. We all know about these, and most of them have been expected. There have been a couple of surprises. Surprises were WestRock, which happened yesterday, and Western Digital, which was earlier this week. The thing that I found interesting about both of these cuts is that they both had really good quarters. Well, okay, WestRock's quarter was fine. Western Digital's quarter was really good. Western Digital actually had revenues up 14% year over year. Both of these cuts were done from a strategic place of strength by the board and the management. They were not backed into a corner, and they were not forced to cut. But what the board said on both of the companies, in essence, was, we don't have a lot of transparency. We're going to change our capital allocation. We're going to take money that we would have otherwise spent on the dividend. And by the way, WestRock is still paying a quite decent dividend. It's just not what it was. But we're going to take money from what we were paying on the dividend, and we're just going to pay off debt, because that's what we're going to do in this period of lack of transparency. And while I find that frustrating, I can't fault the companies for it. It's the right decision for what they know and for their businesses. And I think that they're trying to protect the shareholders in the long run. In the case of Western Digital, what we did was, on the spot, we switched out of Western Digital and into Seagate. These are very equivalent companies. We've owned them both over the years. We know them both really, really well. We were actually Seagate had just reported the week before. In their case, they had revenues up 18% in the quarter, and they stood strongly behind their dividend. That's that board and management's capital allocation choice. So we're actually able to increase the income at the point of that trade. We went from a 5% yield on Western Digital into a 5.4% yield in Seagate. I think they both have the same upside potential from here. Just one other thing while I'm on the subject of Western Digital. It's been an interesting company to own. So those of you who've been with me for a long time know that we initially bought it back in 2017 and paid $40 a share for it. Sold it about a year later in 2018 for $102 a share. Bought it back in 2019, at the beginning of 2019, for $37 a share. In the beginning of this year, it had grown so much that we trimmed our position when it was at $69 a share, and then got out of the rest of it at $40 a share. So even though there's been so much movement, we've actually made a lot of money in this company. And yeah, we sold it off of its peak, but it was great that we used our discipline earlier in the year and trimmed it when it was at $69 a share. And that's the way that we can keep growing over time and, recycling the capital into higher growth or better growth or higher income companies. So just to give you an idea, that's some of the movement that you've seen this week. Let's see. I would caution everyone about focusing too heavily on the losers. I get emails and I was teasing one of you today. I'm like, oh, so you noticed that, but you failed to compliment me on what a wonderful quarter B&G had and what a wonderful quarter Hercules had. I think it's human nature to look at the negative, but I don't think it serves us particularly well to overly focus on the negative stocks and obsess over them too much. One of the things that I think is interesting is last year, the worst performing stock in the portfolio was B&G Foods. And I can't tell you how much flack I got during 2019. Like, why do you still own it? Blah, blah, blah. Why don't you use stop losses? Hasn't it violated this? But meanwhile, I was checking in with the company all the time, talking to the CFO repeatedly. We visited them at headquarters to make sure that, we could really see for ourselves that everything was going as well as we thought it was. They were standing by the dividend. They have tons of cash on the balance sheet. And the interesting thing is that's the best performing stock in the portfolio this year. I don't know if you guys remember, but we increased our position in it after our meeting with them at headquarters in March. We increased it at about $15 and change, and now it's at $20 and change. Look, I know this is a one-off, and just like I don't want people to cherry pick the losers, I shouldn't cherry pick the winners. But I do think it's interesting that sometimes one year's worst performer can be another year's best performer. All right, I touched on Western Dig. I think that's it for me for the equity income strategy. Going forward, there's just going to be a little bit more of this transitioning and recycling. I know last week I mentioned that we've been working on the insurance companies. It's been really interesting. I've ruled out most of them. The one that I'm on the final stages with is Unum. I spoke to the company management yesterday. There's more work to do on it, but it's really, really interesting and compelling. And then there's two other larger capitalization companies that we're working on too. One of them reports earnings tomorrow, Thursday, and I need to hear that before I'm willing to move forward with it. But things are going well, and the portfolio that's coming out of this is really tight. And I know I've said this before, but if these companies have made it through 08, 09, and now this, I don't know how much more bomb-proof they could be. So I'm personally feeling a lot better about the portfolio than I have in the last couple months. And starting to feel a lot like there's a lot more clarity out there, which is reassuring for someone who likes control, which I do. Okay. All right, Greg, your turn.
All right. International, we had one disappointing announcement last week with Royal Dutch Shell, who has done so much to protect their dividend for several years. And no matter how difficult the operating environment has been, they've stood by their dividend. But finally, they gave in and cut their dividend down by a little bit more than half. So we'll probably we'll need to sell Royal Dutch Shell. Interestingly, Total reported, I think yesterday, and they decided to maintain their dividend. And they actually issued a scrip dividend, which allows investors to reinvest their dividend back to the company, which to give them a little bit more financial flexibility. So it was disappointing. We can replace it. And we'll, even with the dividend cuts, so that's 3 companies that have cut their dividends, the yield in the portfolio is still 5.3%. I think there's an opportunity as we sell the companies that have cut their dividend, we can add some more yield back into the portfolio. There's a lot of good opportunities in the market. We're just trying to get the timing right on selling the ones that have cut their dividend. One observation, though, I've seen in the international portfolio is that anecdotally, I don't have the data behind it, but anecdotally, the commentary and the earnings so far from companies in Asia have been better than we've seen in Europe and emerging markets, in many cases from the US, but that hasn't been rewarded in the market. So the backdrop of that is that the economy in China is doing much better than the economies around the world. They had the virus earlier, cases have come down, they've had an economic rebound, and that's benefited a lot of the countries, their neighboring countries that depend on China for growth. And on top of that, Korea has had cases close to zero and has resumed a lot of economic activity. Japan and Singapore have had ups and downs of the virus. Now they're back into a shutdown, but had been previously holding up better. So our companies in Asia have reported numbers that I think have been a little bit better than expected, better than their European peers, and just given commentary that's a little bit more optimistic than we've seen elsewhere in the world. But the share prices have not performed well. And I think that disconnect should provide an opportunity to perhaps, there might be some more investment opportunities in shifting away from companies in Europe that have been hurt more by the virus and into more Asian companies. We've been buying more in Asia over the last 6 to 12 months, increasing our exposure to Japan, a little bit more to China before this. So that's something at the margin I think we'll see over the next few weeks, is perhaps more opportunities in Asia versus elsewhere in the world. As far as the growth portfolio, we're about halfway through earnings season on the growth portfolio, where most of the earnings have been as expected. I think the one takeaway from earnings so far that I've liked from our holdings in the growth portfolio is the resiliency of free cash flow. So the growth portfolio, if you don't know, the idea is to own companies that even during the toughest times can continue to deliver positive free cash flow, and that creates opportunities for them to reinvest it or to find ways to take advantage of by having more cash flow, either returning it to shareholders or reinvesting in investment opportunities. And the one theme so far has been the resilience of the free cash flow generated by our companies. And even in some really tough sectors, so whether it's Aptiv, an auto parts supplier, or XPO, a logistics and shipping company, we've found the earnings and the cash flow to be quite resilient, which is exactly what we've expected. Now, the second part is that we need the market to appreciate that resiliency. We're working on that. We're having a good quarter in growth, but certainly could be better to rebound after the first quarter. But at least so far, the earnings have been a little bit better than expected.
Yeah. I know it's been surprising, I think, that the earnings have been better, better than expected in all of the portfolios. And again, maybe our expectations were really low, or maybe it's January and February being good months. But it'll be curious to see. How numbers start to shape up. And I'm dying to see the economic data start to emerge as we get out of May. The Starbucks here in New Canaan opened yesterday for the first time, and there was a huge line outside. Everybody spaced out, masks, people standing in spots, but you could just tell. Like, who cares if they get their Starbucks coffee? People were just so happy to be able to go back and get Starbucks coffee. So I'm curious to see what this pent-up demand may or may not look like. Anyway, with that, I think we'll open it up to questions. I have just one that was emailed in, and it was the reminder that you do not need to take your required minimum distribution this year. So if you're taking money from your IRA and that's taxable, if you don't want to take that, you don't have to take that. If you have other accounts that you can take it from this year, you can take it from other accounts and not need to pay taxes on what you take out of your IRA. So that's a big deal in terms of tax savings for next year. So anyone who wants to take advantage of that and should, if you need any help with it, if you have IRAs outside of Gilman Hill that you want to ask about or talk about, please, feel free to use us as a resource on how that works. I know they also changed the rules on inherited IRAs. And our partner, Jonna, is more of an expert on the nuances of that than I am. But so if you have an inherited IRA and you want to rethink how you're taking money from that, you're welcome to talk about that too. The other question was about the dividend cuts. So I think we covered that. So with that, I think I'll open it up to questions. So if anyone has questions, please just take yourself off of mute and feel free to ask. Anybody? And don't feel like you have to. I know I've talked to everybody offline, I think. So anyone got anything?
I'm curious about what your thoughts are on inflation, because it looks like we are going to continue to have to spend money or reduce production in order to keep safety up. And sooner or later, those costs have to migrate their way through, as we're starting to see with meat. But I think we're going to see it everywhere. I mean, if a restaurant opens up and they can only do 2/3 capacity, at some point, they've got to raise their prices in order to stay viable. And, other similar things. So I'm just curious about what your thoughts are there.
That's a great question. That's something that I've really struggled with, and I'll let Greg weigh in on this too. But initially, I was thinking that inflation was going to come from just the helicopter drop of money, right? And that there was just so much more liquidity and so much money in the system that would eventually trickle its way into inflation. And I think you're right. Now we're seeing, the potential for inflation coming from things like decreased availability of meat or or restaurants needing to raise prices. But as I've read more and more, I'm not sure that that's where the real risk is going to be to the fallout from this. And what I wonder is, and I've heard some really decent arguments on why inflation may not take hold and why that may not be what we worry about. But what I personally worry about, and if I've said this on a call before and I'm repeating myself, I apologize. But what I think the real fallout from all of this is that scares me is a much lower growth rate on invested assets or on investable assets for the future. And I don't think, I think what I mean is this. Historically, we always say, oh, the S&P, the market's returned 8 to 10% a year, on average, over time, blah, blah, blah. I think that the huge amounts of debt that we're taking on, the huge amounts of liquidity that have been pumped in, I think that those will ultimately decrease our ability to grow the way we have in the past. And I think for everyone on this call, that doesn't matter too much. You're all wealthy, or you wouldn't be in this group. You have your own portfolio that's yours. And if your portfolio grows at 5 to 6% or 6 to 7% for the rest of your life, that is not going to be meaningfully different than if it grew at 8 or 8.5%. We can figure out a way to work within that. Where I get worried is thinking about the huge public employee retirement systems that completely depend on growth rates of 8% plus to pay out the benefits that they've promised all of their employees into the future. And I don't know when that comes to bite us, but that's what I'm worried about more than inflation as a problem for the future. But let me turn it over to Greg and see if he has different or other thoughts.
I want to say, I can't wait for the day that I'm worried about inflation, because it seems so far away. But Goldman Sachs actually just wrote a report on this I think it was on Monday, knowing that this is coming, that anytime you have the start of an economic recovery, as we're in the very early stages of it, and from a very low level, but anytime you have a start of an economic recovery with a lot of policy stimulus, there's the natural question of, inflation's coming. When is it coming? And they definitively say, do not worry about it. That's their view. That this has been a very unique recession, one where one of the few times where you have a cut in production at the exact same moment as you have a cut in demand. Usually that you don't get that matching. The demand falls off, and while the companies are still producing. But this, because of the virus, we couldn't go out to shop, but we also couldn't go to the factory to continue to make items or import items or produce services. So there's been a pretty good matching. So far, I think inflation would be under control, even with the amount of money the Fed is dumping on the market, and how much the federal government, how big of a deficit they're running. The risk to that view would be that the dollar collapses as a result. Right. But I think a lot of other countries are in the same position. They're going to be increasing their fiscal stimulus, their monetary stimulus, so it will even out. The dollar has strengthened a little bit through this. So far, but I look forward to those days where the economic activity has accelerated so much that
you look forward to them, back. And then you'll be eating your words and regretting having looked forward to them. Just like I used to look forward to an exciting market.
But I think I think it's helpful to look to Europe, because they reopened their economies a little bit sooner than us. What we've seen so far is that even though retailers and restaurants have reopened in some way, the demand hasn't returned. That it's easier to reopen than to get someone out of their house to feel comfortable enough to go into a store or need to go to a store and purchase discretionary items. That hasn't happened yet. The U.S. may be different, but at least from the people I've spoken to, most are still pretty cautious about leaving their homes.
Yeah.
Well, with all due respect to Goldman Sachs, they're looking at demand versus capability. I think what we're going to see is a cost push. And I'll go back to if a restaurant has to function at 75% capacity, they're going to have to raise their prices. But one thing we know is going to happen, we're going to start to onshore manufacturing. As we bring product back to this country, the costs are going to go up. So, it's one thing to have the demand effect changing prices. It's a whole other thing to say our whole cost basis is changing. You
Yeah.
know,
Yeah, it's true. We will start to, I mean, I think that trend was happening already where we're starting to onshore the production of more goods, starting with the trade war. That moves very slowly though. It's really hard to take production from China and move it back here. There's just the scale that's needed. So it'll be slow. At the same time, the other inputs, well, I mean, food costs may go up, restaurants may be operating less efficiently. The where the input costs are going down, labor, if the unemployment rate's going to be above 10%, you're not going to see the 3 to 4% wage growth that we've been seeing for several years. The energy price is a lower cost. Interest rates are at lower levels. So there are some offsets to that, but I did get your point that restaurants, they should charge more in order to try to stay in business, and then we'll see if people continue to return. It's going to be a luxury to go out to dinner, but that should be resolved hopefully within 2 years. Am I being too optimistic?
I don't know, but I think it's interesting too to think about the fact that, inflation in and of itself isn't bad, right? And frankly, a little bit of healthy inflation might be might be a good thing from an economic perspective. So it's, if it spikes, if it gets out of control, that's where we have a problem. And I'm not sure that we can plan for it right now. I think all we do is stay nimble in what we're doing and keep an eye on it. One of the things Greg asked me earlier today, which was interesting, he said, I can't remember how you phrased it, Greg. But he's like, what's your, what framework are you working with? And I'm like, well, what exactly do you mean framework? And he said, in terms of recovery, what's your framework now? And I said that we're totally, that we're back to normal and comfortable going to the movies and going out in the way that we were prior to this in 18 to 24 months. And then we started debating what timeframes matter for an economic recovery, for inflation coming back and for growth slowing or taking off. So I just think we don't know. And I think that's what's hard. And then Greg pushed back on me a little bit when I was saying 18 to 24 months, because that is a long way away and things are changing quickly. So I think right now we just need to stay flexible, or as flexible as we can in our outlook, and adjust accordingly as we go.
I'd like to share a positive note. The other day
Okay.
I went to a center that had a lot of fast food places, and everything was just takeout. You couldn't eat in the restaurants, but the parking lot was as full as it was pre.
That's interesting.
Yeah.
Huh. Yeah, that's really interesting. And apparently the Starbucks that reopened down in Virginia are causing traffic jams. So yeah, that is interesting though. Thank you, Gary. Who else might have a question?
What restaurant was that?
What do you
Was
mean?
it a chain? Was it a chain?
I think Gary was saying it was like a restaurant park.
Yeah, it was like 10 or 12 stores.
Yeah.
Oh, gotcha.
Yeah. Who else? Anyone else got something? Okay, so maybe I'll say speak now or forever hold your peace. But I'll say I think we're probably going to go to every other week, or if things get crazy, we'll do these as necessary. But I think we're going to dial it down on the every week. It's just this week, and maybe it doesn't feel like this to you all. And if you think I'm wrong, please email me. If you want me to keep it up every week, and you all email me and say, please keep it up every week, we will. But it felt like there wasn't a ton of new and exciting news to share. So I think I'd like to go to every 2 weeks for this, if that's okay with all of you. Again, happy to do it more frequently, but also we are so happy to do individual calls, and we can do them via Zoom. I've been having a lot of lunch and coffee dates with clients to talk about stuff from my desk, and that's been really helpful too. And I do think maybe, talking about the individual portfolios and your individual allocations and what's unique in your portfolios is helpful too. So if you're okay with it, we'll go to every 2 weeks and as many individual calls in the middle as you need. But email me if you think that's the wrong decision, and then we can keep it up with once. So thank you all so much, and have a good week, and we'll see you soon.
Bye.
Bye, everyone.
Bye-bye.